Steve Greiner, the RV driver again. A couple of things I just point out. I've been a technologist most of my life, or my life prior to coming into finance. But one of the issues you have with a Microsoft with lots of money to spend is that it's difficult to come up with innovative ideas which are multi-billion-dollar ideas. It's easy to come up with business models for technology that are, $5 million revenue, $25 million revenue, or $50 million revenue. I mean, most of the innovations that occur throughout history usually comes from small endeavors. And the story I give had to do with the technology I had created years ago when I worked at Allied Signal, when the total market had to do with automatic prototyping and the ability to convert automatic prototypes rapidly into CAD/CAM software. This is circa late 80s, early 90s. And when I actually had a chance to speak in front of the board, they were taking scientists and occasionally threw them out there just to see what would happen. It was in my young career at the time, I was told, thank you, it's a great idea, but we don't need million-dollar ideas. We need billion-dollar ideas. And the question I also asked, and I don't know this, but in the early 80s when PEs of tech companies were smaller, were they as large a corporation relative to the market cap of the S&P? I suggest, and maybe I can stand corrected, that Microsoft and Google and these firms are much, much larger in terms of their market cap than the technology companies of the 70s and 80s.
Was there a question you have for me, or no? Okay.
Hi, Martin Lee, T. Rowe Price. I was just curious from your comments, what your reaction would be to the thought that perhaps the innovation was more on the capital market side and the ability of the capital to find best investment, and hence that's the reason why return on capital had been stronger than return to labor over the past 30 or 40 years, and that's what sustained the GDP growth in the during the period.
Well, there certainly are both positive and negative versions of that argument that get made a lot. Sort of the more negative version is that we have people doing financial engineering instead of real engineering, and I think finance tends to get blamed a little bit too much in this whole thing. But I would sort of reverse it, and I would ask, why were we in a situation where so much of a premium had to be placed on financial innovation? I think there's been a decent amount. Things probably got pushed too far in the last decade, but in general, there's probably been a decent amount of significant innovation in finance over the last 30, 40 years. And I think one of the reasons so many talented people were attracted into finance was because on some level it was just too hard to get anything to work in technology, and so I think there's sort of a half full, half empty thing where people are a little bit too facile about saying, well, everybody should just go from Wall Street and back to working in a factory, and it's actually not clear there are that good a return there. And so I think the question is, was it because returns on finance were good, or because returns elsewhere were bad? That's sort of the second order question one should ask. Yes, sir.
Frank Avella, Investment Partners, Asset Management. Some of us are old enough to remember General Dorio at American Research and Development. He used to say that the function of Wall Street and the investing process in small, innovative companies was to, in a sense, reward those who were willing to take the risks. And at the same time, Wall Street's role was to amass capital in behalf of men, it was a sexist remark, men and ideas. Then sometime along the way, during that period when we had the unprecedented growth, we moved towards the cynicism that I have for Wall Street, which is to get the outs in the ins out. So to the degree that if we made you king for a day, and we looked at the future and the way to be able to tilt it to the way it might have been in a traditional sense, and we made you king for a day, what policy initiatives would you use, and how would you employ them, the priority and the way you applied them?
Well, I don't have any, obvious answers to the problems I've raised. It seems to me that the big thing I would want to shift in the U.S. is to somehow encourage things people to have a longer time horizon. So, I think if you compare the U.S. with China, I think we're better than China in every single dimension except for one, which is that China thinks, ahead 30, 40 years, and we're not thinking ahead on that sort of time horizon. And that may be a sufficient difference that will enable China to overtake the U.S. in the decades ahead. And so I think, there are questions how to do that, and it's basically, I would try to shift the tax code towards encouraging investment and discouraging spending. So, reduce cap gains taxes to zero and substitute them with sales taxes, and that's the kind of thing I would try to do. In terms of giving people education, paying for education, I would differentiate it very heavily between what people are studying, and so you give people scholarships if they're studying engineering or the sciences. Maybe not give people scholarships if they're studying, PE or something like that. Even though there's nothing wrong with people studying that, and there's nothing wrong with people spending 4 years surfing on the beach. But we shouldn't be subsidizing that.
Thomas Korscher, Pennsylvania Avenue Funds. It seems to me that one of the reasons why the big companies have so little R&D expenditure is because a lot of R&D expenditure is hidden in goodwill write-offs. And I think Cisco and Oracle are some of the worst offenders in that respect outside of the pharmaceutical sector. So the big companies will buy up research by buying smaller companies and then eventually write off the goodwill. And I think that's one of the reasons why you don't see so much R&D expenditure.
That's quite possible. It's similar to the comment from the other gentleman. Although, if that is true, and that again suggests that most of the R&D is in effect being driven by smaller startup companies that then get acquired by bigger companies, and then I think you have this residual question of why the venture capitalists aren't making more money. That remains very serious under that scenario. So I think you're right, but you have this sort of cup and ball game. Is it the universities, is it the small companies, is it the big companies? So if it's not the big companies, and then we think there's something maybe off with the universities, and it's not the small companies, where is it? And I think there are very good arguments that it's not this, it's not this, it's not this. But the question is, what if it's none of them?
Jorge Mariscal from Droeton Group. You touch on China, and I wonder if your conclusions are not a little bit narrow and focus on the U.S. and the developed world, because clearly over the last 36 years there's been a massive improvement in the standard of living of the emerging markets, not only China, but pretty much all of them. And so there may be something about the technology becoming cheaper and more accessible that has increased global productivity in a way that you're underestimating by just looking at the U.S. And that we're still in the early waves of that. You just have to look elsewhere for where that productivity growth will happen and where the opportunities will be.
Well, it's possible. Let me give you two somewhat different thoughts on this. I tend to think that the main story about the emerging markets is that there's no need for any innovation whatsoever. All you have to do is just copy ideas. It's the line from Aristotle that man differs from the other animals in his aptitude for imitation. And all that is happening in India, China, places like this, is it's just copying stuff, and basically it's getting those countries getting the plumbing from the 19th century and the railroads from the 20th century. Zero innovation, and there needs to be zero innovation in any of those countries for them to see tremendous per capita progress. And so if you're an engineer or something like that in China, you should just be building railroads or something like that. There's no need to be doing anything innovative. You can do quite well just catching up, and because things were, as you said, extraordinarily disconnected. But I think, I think the question, and I think the question I focused on was more a question about the developed world, which is still 70% of the world's GDP. It's still going to be very important in the next 20 years. And what is very odd is that the story about massive growth in emerging markets, the way it normally gets presented in sort of a McKinsey-like, sort of Panglossian view of the world, is that everybody wins, and maybe people win a little bit more in emerging markets, but they produce more. It's good for the developed world, and it's sort of this win-win synergy. And so the very odd thing is, even with all this progress in emerging markets, why hasn't it filtered into the developed world? Why have wages been stagnant for 36 years when presumably there's way more stuff we can export to these countries that used to be, incredibly poor and now are sort of, somewhat poor? And so I think there are sort of, I think you're right, the emerging markets have a lot going for them. Maybe it's a little bit overrated right now, but I think it points to a lot of very hard questions about the developed world.
Keith Rosenblum from Clarium Capital. Two questions. First, I wonder if the reason why the data point that you used about the venture capital returns being stagnant aren't more a function of the fact that the venture capital business model seems to have bumped up against itself due to the size constraints and limitations. If you look at the size of venture capital firms, they've grown so much over the last 20 years, just the size of their funds, that in order for an investment to be worthy, they need to put enough capital to work that might have been the revenue level of a successful company 20 years ago. So just an observation and maybe comment on that. But more to your point about current technology businesses, do you feel that the current technology businesses are simply overvalued, that their valuation metrics are simply too high today to be sustainable given their growth rates?
So two separate questions. Let me start with your second one. It's not clear that even if one is somewhat pessimistic about the arc of technology, that it implies that companies that are considered to be tech companies are overvalued today, because I think most tech companies are actually functioning as these entrenched businesses that just produce profits for a long time, and they're not really tech companies at all. They're basically just they're basic. Most tech companies involve bets against innovation and, in a sense, against technology. And so, like, General Motors was a tech company in the 1920s. In the 1950s, it was a very profitable company, but an investment in General Motors was basically a bet against technology. It turned out to be a bad bet because there was enough that happened in Japan and elsewhere. And I think, in the 80s, Microsoft was a bet on technology. Today it is a bet against technology. And most tech companies are actually bets against technology. So to the extent there isn't that much tech happening, it paradoxically may actually be mildly bullish on a relative basis for a lot of tech stocks, where there's going to be sort of less disruption to the business models, and they'll be more predictably profitable than people think. And in some ways, that's what seems to have been happening in the last few years. I think the venture capital being saturated is obviously one alternate explanation. I would say a couple thoughts on that. The main one is, if you actually look at the number of IPOs, it has gone way down, and it's maybe 1/10 of what it was in the 1990s. Obviously, there was going to be a dearth of them for a few years because so many companies went out during the tech bubble where it was premature. But the dearth has gone on, I think, a little bit too long. I remember when Google went public in mid-2004, there were a lot of stories written about how this was the beginning of a new IPO wave. And it's basically been as much time has elapsed since the Google IPO, more time has elapsed since the Google IPO than between the Google IPO and the end of the tech boom. And we still have very few IPOs in the pipeline. And I don't think, again, that it's just Sarbanes-Oxley, even though I think that's a terrible law. But I think if we look at the size of the IPOs, how big the companies are, it just seems that there's less going on. And so, while I think venture capital was maybe too small as an industry in the 70s and 80s, and therefore was sort of unnaturally profitable, I think there is a degree to which the expectations are still being geared too highly today because there's not quite enough going on.